Okay, welcome back. Now we're going to talk about what is a statement of receipts and payments. All right, so on the screen you see an example of a statement of receipts and payments. Okay, so it is essentially an accounting report that details cash received and cash paid during a reporting period, and it shows you the change in the firm's bank balance over that period. Okay, so similar to balance sheet and profit and loss statement, you always have the business name on the top. Okay, you have the name of this particular report, the statement of receipts and payments stated. Note it's for the quarter ended 31st December 2015, so it's for a particular period. It shows you the cash inflows and cash outflows over a given period of time, as opposed to as at a particular date, okay, which is the case for balance sheet. All right, so what you have, the first heading is cash receipts. You have all the cash receipts here detailed. So let's have a look at what are they. Okay, so in this case, you've got cash sales, okay, receipts from debtors, okay, that's debtors paying you back from credit sales. You have a loan, so borrowed a loan from Ausbank, capital contribution from the owner, and GST received. All right, so all of these added up give you a subtotal for the cash receipts for the quarter, less cash payments. Okay, these are the cash payments. Let's have a look at the cash payments. So we've got payments to creditors, wages, drawings, GST paid, electricity, prepaid insurance. Okay, a payment we made in advance. Shelving, so you made a payment to purchase some non-current asset. Interest expense, loan, this is the loan repayment, and office equipment, again paying for a non-current asset. Okay, all of these totaled up give you the subtotal for the payments, for the cash payments over the quarter. Okay, the difference between these two figures, okay, will give you this figure, okay, either a surplus or a deficit. In this case, it's a cash deficit for the quarter. Okay, added on to that is the bank balance at the start of the quarter on the 1st October 2015. Okay, add to the change, give you the bank balance at the end of the quarter on the 31st December 2015. That's how much you're left with at the end of the quarter. All right, so why do we need such a statement? Okay, so we're analyzing the sources of cash receipts and uses of cash payments. The report helps the owner to understand why cash balance has increased or decreased in a particular way. Okay, definition for cash surplus. Cash surplus is an excess of cash receipts over cash payments, okay, leading to an increase in the bank balance. Cash deficit. The definition for cash deficit is an excess of cash payments over cash receipts, leading to a decrease in the bank balance. Okay, here is the formula to calculate surplus or deficit. All right, now it's your turn. I want you to have a go at exercise 12.1 in your textbook, page 277. Okay, cash flow statement. All right, note with the statement of receipts and payments, it only classifies cash transactions as either receipts or payments. So it's fairly general categorizations, either cash inflows or outflows. It's a rather basic rudimentary classification and doesn't provide much detail about the sources and the uses of cash. So why do we need a cash statement? Cash flow statement. Cash flow statement reports on cash inflows, cash received, and cash outflows, cash paid, and also separately identifying cash flows relating to what we call operating, investing, and financing activities. So certainly the cash flow statement does give you a much more detailed breakdown of all the sources and uses of cash. Okay, let's have a look at some definitions here. It's important to get the terminologies, understand the terminologies fully here. Operating activities. Okay, what do we mean by operating activities? Operating activities refer to all cash flows related to the firm's day-to-day trading activities. Okay, all the activities related to the day-to-day operations. Examples of operating inflows include cash sales, receipts from debtors, GST received, and any other cash revenues such as commission revenue. Okay, examples of operating outflows include payments to creditors, GST paid, prepaid expenses, or any payments for expenses incurred, wages, rent, electricity, all those expenses are considered to be your operating expenses. Investing activities. Investing activities is quite specific. It refers to cash flows related to the purchase or sale of non-current assets. Okay, so it's only related to the purchase or sale of non-current assets. Examples of investing cash flows are cash paid for the purchase of a non-current asset. Okay, so that's an investing outflow, or cash received from the sale of a non-current asset, an investing inflow. Financing activities. Okay, financing activities refer to cash flows related to changes in the financial structure of the firm. What that means is it refers to cash transactions that change loans, either loans or owners' equity. Basically changes how the business is financed. Okay, so you can either borrow money from lending institutions, or the owner can contribute his or her own capital. So this is going to affect the financial structure of the firm. Okay, examples of financial cash flows, of financing cash flows are cash contributions, okay, or drawings by the owner, and receiving or repaying principal of a loan. Okay, let's have a look at an example of cash flow statement. Okay, again, you've got the name of the business on the top and the name of the report, cash flow statement, for the quarter ended 31st December 2015, because we are reporting on cash inflow and outflow for a particular period, for a given period of time. Okay, so to take note of the headings here. Okay, firstly we start off with cash flow from operating activities. Okay, then you list out all the cash inflows related to operating activities. The obvious ones: cash sales, receipts from debtors, GST received. Okay, less the cash outflows. Okay, again, these are the cash outflows related to operating activities only. Payments to creditors, wages, GST paid, electricity, prepaid insurance, interest expense. Okay, take note of interest expense. Interest, it's related to the loan, but it's not considered to be one of the financing activities. It is categorized under operating activities. All right, so use your cash inflows for operating activities. Subtract the cash outflows from operating activities, gives you the net cash flows from operations. Okay, in this case, it's a negative figure. All right, negative figure is you would normally expect to have positive figures for net cash flows from operations. Okay, at least from the operation side of things, business should be generating cash inflows, or else in terms of liquidity, the business might run into difficulties. Okay, we'll talk about that later on. Okay, so the next section is cash flows from investing activities. Okay, again, you have list out any cash inflows. If you've sold any non-current assets, then there would be a cash inflow here. In this case, nil, nothing. Less cash outflows. Okay, any cash spent on purchasing non-current assets, shelving office equipment. The subtotal, the net cash flows from investing activities, is negative here because you've bought non-current assets. Okay, last section, cash flows from financing activities. Cash inflows, okay, borrowed loan from Ausbank, okay, and capital contribution by the owner. So 30 grand in total, 30,000. Cash inflows from financing activities, less cash outflows from financing activities. Drawings by the owner, cash drawings. Loan, this is referring to the loan repayment. Okay, so 30,000 take away 14,700 gives you the net cash flows from financing activities. Okay, so what do you do next? You add up, okay, these three figures. So net cash flows from operations and plus net cash flow from investing activities plus net cash flows from financing activities gives you the net increase or decrease in cash position. In this case, over the quarter, there's a net decrease in cash position by 6,270. Okay, and then you add that to the bank balance at the start of the quarter, 1st October 2015. Okay, and it should give you the bank balance at the end of the quarter. Okay, 7,230. So that's how, that's what a typical cash flow statement looks like. Split into three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. And you work out what's the net increase or decrease in the cash position added on to the bank balance at the start of the period. Okay, gives you the bank balance at the end of the period. Okay, so the key to prepare cash flow statement is you need to have very clear understanding of what cash flows belong to which category. And one way to double check the figure, the ultimate figure we're talking about here is net increase or decrease in cash position as reported in the cash flow statement, is to deduct the total payments in the cash payments journal from the total receipts in the cash receipts journal. Okay, the answer you obtain, they should be the same. And also the net increase or decrease in cash position figure in the cash flow statement should be the same as the surplus and deficit figure from the statement of receipts and payments. All right, and the bank balance at the end, the figure should be the same on both the cash flow statement and statement of receipts and payments. Why? Because in essence, both the cash flow statement and the statement of receipts and payments, they report exactly the same information. The only difference is that the cash flow statement has more detailed classifications, and it classifies cash flows according to operating, investing, and financing. But both statements, the cash flow statement and the statement of receipts and payments, they include the exact same cash inflows and outflows. All right, please have a go. It's your turn. Have a go at these exercises 12.2 and 12.3 in your textbook. Okay, and please remember to watch the next video, part 3.